Good morning and welcome to Financial Accounting. So excited to say the mask mandate has been lifted for on-campus activities, so I no longer have to have my face covered. Might help you to better understand me on the videos too. As we look at our calendar, no more mask required, just so you know. So as we look at our calendar, last day of February, the plan will be to finish up chapter 5 today. We do have quite a bit left to go, so we'll get into that right away as soon as we go through where we are. We'll be starting with exercise 4 in chapter 5, talking about accounting for merchandising operations. And so if we finish chapter 5, then the chapter 5 exercises should be submitted for grading by the end of the day today. And then the problem due on Wednesday. We may have to carry the end of the morning, just so you know there's no more mask requirement on campus. You're welcome to wear them if you feel more comfortable, but you're not required to. So we may have to carry a little bit of chapter 5 over to Wednesday, and but either way, we'll be also starting chapter 6 after that on Wednesday. So the chapter 6 pre-quiz due on Wednesday by the end of the day. If we need to carry chapter 5 over, I'll take a look at the chapter 5 problem at the end of class to make sure that we will have covered everything that's in that problem, so you'll know if you are whether chapter 5 problem will still be expected on Wednesday or not. Chapter 6 is the third and final chapter for our second exam. So as we look ahead, chapter 6, we'll be finishing that up next week. And so we'll then be ready for the chapter 6, the exam 2, which covers chapters 4, 5, and 6. So as you're looking ahead, not this weekend, but the following weekend, starting March 10th through the 13th is the exam window for exam 2, as well as project 2. So I'm working on your part 1 projects right now so that you'll have feedback on those before you start working, at least before you start looking at submitting your second project. So 2 more weeks until that is due. Any questions about anything at this point? So let's, without further ado, get to our exercises here. So you should have your chapter 5 exercises open. We did the first 3 exercises together in class last time, talking about payment terms and freight terms and the concept of periodic versus perpetual inventory systems and what that looks like. We talked about freight in, freight out. And we're going to pick up in exercise 4, which will be a review for us based on what we talked about last class. So without further ado, let's get right into our exercise. In this exercise, as you can see, we are the seller. So we're looking at the sales related transactions. Showcase Company, a furniture wholesaler, sells merchandise to Balboa Company on account. The cost of the merchandise is $254,500, and the terms are N30 or net 30. So based on what we discussed last class, there's no discount for paying early. The full amount of the invoice is due 30 days after the invoice date. The cost of goods sold is $152,700. So that's how much it costs Showcase to buy those that merchandise from its supplier, and then it sells it for $254,000. Term we introduced last class, the difference between those two numbers is referred to as the gross margin or the gross profit. The increase or the excess over the cost of the merchandise and the sale. The difference between those two. Showcase Company issues a credit memo for $30,000 of merchandise returned prior to Balboa Company paying the original invoice, and the cost of that merchandise was $17,500. So I'm going to go through this fairly quickly because we did already cover this last class, but certainly if you have a question, if you don't understand something or don't recall what we had done, please make sure you ask. Letter A is to account for the sale, including the cost of goods sold. So we can tell that this company uses a perpetual inventory system. When they make the sale, they immediately, at the same time that they record the sale, the revenue, they record the cost of goods sold and remove that inventory from their inventory account. So we start with the sale. It was sold on credit or on account. And so we will have an account receivable for Balboa Company, and we record the revenue. Because we use a perpetual inventory system, we're going to relieve the inventory at the same time and record the cost of goods sold. So nothing new there. Any questions about that part though? So that invoice is not due for 30 days, and sometime before that invoice was due and paid by Balboa, Showcase issued a credit memo to Balboa because they returned some of the merchandise that they, for whatever reason. The assumption is, because we're not told differently, the assumption is that the inventory can go right back on the shelf, or it's still saleable. For some reason, Balboa didn't want it and they returned it, but it's not defective, it's not damaged. And so we're going to put it right back in the inventory. So when we issue the credit memo, we are going to remove that piece from our accounts receivable. $30,000, Balboa no longer owes us. And so now if we were tracking this in T accounts, we'd see Balboa did owe us $254,500, but now they owe us $30,000 less, or only $224,500. And that's how much they'll pay when they pay that invoice at the end of the 30 days. Because they're returning it, we're going to debit this to customer refunds payable. Okay. And then we have to restore the inventory to our inventory account. And its cost was $17,500. And the credit side of that will be estimated returns inventory. So when we get into the accounts receivable the receivables chapter, chapter 8, I think. When we get into that chapter, we'll be talking more about what these estimates are, the estimated returns inventory, that at the time that we record the sale, we need to record, this goes back to the matching principle that we talked about in chapter 3. At the time that we record the sale, so we have the revenues on our income statement, but we need to make sure we're matching against those revenues any of the costs or expenses associated with those revenues. That's what the matching principle tells us we have to do. And so at the time we record the sale, we're going to be estimating a number of potential costs associated with that sale. And one of those is the potential that customers might return inventory to us. One of those, as we'll talk about in chapter 8, is when we make a sale on credit, there's a chance that our customer won't pay us or can't pay us when the bill comes due. Questions so far? Okay. So looking at letter C then, now they're going to pay the amount that they owe. And we already explained what that was. The original 254.5 minus the $30,000 return. And so the amount that they owe is $224,500. They're going to pay that, so we're going to receive the cash and reduce that account receivable because they no longer owe us that amount. Okay. Questions on that exercise? Green check marks in there, so we'll keep going. And on our next exercise, we're going back to the purchases side. So again, this is mostly review of what we had talked about. We are now those exact same transactions that we just saw in exercise 4 when we were the seller, we're now going to look at from the buyer side, from Balboa Company side. So we are now Balboa Company. Same information that was given in the last exercise, but you'll see that there's really a mirror image of these transactions. If one company is selling, someone else is buying. If one company owes money, the other company is owed money. And so I like the pairing of these two exercises because it gets you thinking about, it's not just, even though, as we said in chapter 2, every transaction has two sides to it internally, a debit and a credit, a push and a pull, a give and a take. But externally, we also have this pairing of transactions. So if we have a seller, we have a buyer. If we have a receivable, someone else has a payable. So let's look at what these same transactions from exercise 4 would look like on the buyer side. So we are now Balboa Company, and we are going to record the entry for the original purchase. So Balboa now has inventory that cost $254,500. Remember, in the previous exercise, it only cost Showcase $152,700, and that's how they had it recorded in their inventory. But for Balboa, they're going to record it in their books at what they paid for it. It comes back to that historical cost principle that we have mentioned before, and we'll hear again and again throughout the semester. So Balboa is going to report it at what they paid for it. They don't even know what Showcase paid for it. They have no access to that information. That's internal. Showcase knows what they paid for it, but Balboa doesn't. Balboa only has a record of what Balboa paid for it. And because they bought it on credit, they now have this account payable that, again, mirrors the account receivable that Showcase has. So Balboa has an account payable for the same amount that Showcase has an account receivable. Now we return that merchandise, and again, because we use a perpetual inventory system, we're going to remove that from our inventory, and when we get that credit memo, we're going to remove it from our payable. We no longer have to pay that $30,000. And again, for Balboa's entry, it doesn't matter how much Showcase had paid for their inventory. Balboa doesn't even know how much that inventory cost when Showcase bought it. They only know what they paid for it. And so that's how it gets recorded in their records. And now, again, when we pay that invoice minus the credit memo, Showcase receives the cash and had a debit to cash. Balboa is paying the cash and has a credit to cash. Showcase credited their account receivable because they aren't owed that money anymore. Balboa is going to debit accounts payable because they don't have that liability anymore. Make sense? All right. Let me go over here for a moment then. Talk about, get this so people in the classroom can see, get those out of the way. And we'll talk about sales tax. So in our next exercise, we're going to be talking about sales tax related transactions. So sales tax is a general tax, not to be confused with an excise tax. An excise tax is applied to a specific product or a class of products. So for example, there are excise taxes on alcohol, on tobacco products, on petroleum-based products like fuel oil or gasoline. Those are very specific taxes on those specific goods or class of goods. A sales tax is a more general tax that it affects most or all products at the same level. The sales tax is generally paid only by the end user or by the consumer. So a transaction that is between a wholesaler and a retailer, for example, does not include sales tax. The sales tax is paid by the end user. Sales tax is collected by the retailer, again, that entity that's selling to the end user. It doesn't belong to the retailer. They're acting as a collecting agent for the taxing authority, which might be the state or local government. In the case of excise taxes, those are frequently federal taxes. And so they're being collected and they are treated as a pass-through. So at the same time that the retailer collects that or bills for it, they're going to record a payable. They owe that tax that they've collected on behalf of the state or local government. They owe it to the state or local government, and they'll remit it all together on the appropriate date. So it might be, the 15th of the month or the 1st of the month or whatever. And so at the time that they assess the tax, either collect it if it's a cash sale or bill it if it's a credit or on account sale, they're going to immediately recording that sales tax as a payable, and it doesn't show up on their income statement at all. Okay, so it is a balance sheet transaction, and we'll see again what that looks like when we go to our first exercise. Most states do have a sales tax. The sales tax varies. In New York State, part of the sales tax goes to the county and part of the sales tax goes to New York State. So when I was a kid, a long time ago, everywhere in New York State assessed the exact same sales tax, and at the time it was 7%. So there was no, and it was a 50-50 split. So half went to the county, half went to the state. Probably 25 years ago, we started seeing the fluctuations where county by county, counties were charging different amounts for their tax. So the state tax piece still remained constant across the state. Everybody paid the same state portion, but the county portion was changing. And so Cattaraugus County, where the Olean campus is located, went to 8%. Now is it like 8.25%, something like that, 8.5%? I don't know. Does anyone know what the sales tax is? It's terrible that I don't know that. 8.5 maybe. Anyone in Chautauqua County, do you know what your sales tax rate is? I think it's actually less than Cattaraugus County. Does anyone know? Seems like we should all know this. Not that people in Olean should know Chautauqua County's rate, but it seems like we should know what we're paying. I believe that Chautauqua County's is a little bit lower than Cattaraugus County's, so maybe it's 8%. It's not private information. Someone could just Google it and put it in the chat later. So as I said a couple minutes ago, most products are subject to sales tax. But again, each state makes its own rules about what it's going to tax and what it's not. So for example, in New York State, when you go into the grocery store, most of the food items in the grocery store are not taxed. But the category of junk food like soda and things like that are subject to sales tax, and prepared foods are subject to sales tax. So if you go to the deli and buy a hot sub, you know, you're going to pay sales tax on that. So I grew up here in Western New York, and I worked in a grocery store when I was in high school. And then when I went to college, I was in Virginia, and I went into the grocery store the first time, and there was sales tax on food in the grocery store. And I was so startled because like I said, I'd worked in a grocery store. I was very aware of what the rules were at the time in the grocery stores in New York because I worked there. And I was startled to realize that in Virginia, regular grocery store purchases were subject to sales tax. However, at the time, the sales tax in a grocery store was 4.5%, but if you went to a restaurant, it was 7%. So it is a governmental decision about what's going to be taxed and how much tax, you know, what the tax rate is going to be. Most of you are probably aware that New York has changed over the years about how clothing is taxed. When I was a kid, all clothing was taxed at the regular sales tax rate, and clothing wasn't taxed in Pennsylvania. And since we live so close to Pennsylvania, people would go into Pennsylvania, go to, you know, the mall in Erie to do the major clothes shopping because there was no tax. And, you know, a big difference between 7% versus no tax. In recent years, New York has had like the tax holiday for back to school shopping where there is no clothing tax or there's no tax on clothing below a certain level. So the higher ticket items might be subject to tax. The point of this and the reason it affects our accounting is whatever that tax is, none of it belongs to the business that's assessing that tax. All of it belongs to the taxing authority that is levying that tax. And so as we look at our next exercise, exercise 6, we'll see how it gets recorded, how it doesn't appear on the income statement of the business. Instead, it's a balance sheet transaction only. So let's go to that exercise. If I can get out of here, go back to our next exercise. Yes, sir.
I did find it.
Oh, good.
Olean has 8%.
Olean's 8%?
Mm-hmm.
Okay.
Alleghany's 8, Downing's 8, Wanda's 8.75.
Part
Yeah.
of Gowanda's in Erie County, so that's
Yeah,
probably the Erie
I have
County
like the
piece.
whole list here.
How about Jamestown? Yeah, Gowanda's funny because it sits right on the border, so part of the town is in Cattaraugus County, and part is in Erie County.
You go inside.
Okay, well, someone who's on Zoom, who probably some of you, I know some of you are in Chautauqua County. See if you can find that tax rate for us. Put it in the chat. But we'll keep going on this exercise. Thanks for looking that up. So here's our sales tax transactions. Journalize the entries to record the following selected transactions. We sold $640,000 of merchandise on account, and that merchandise is subject to the sales tax, and the sales tax rate is 7%. The cost of goods sold was $385,000. So again, because they're telling us that cost of goods sold, and I can see in the template here that they've given us a space to record that cost of goods sold piece, we can tell that this company is using a perpetual inventory system. I wish they would state that, using a perpetual inventory system. I believe the reason they aren't stating it in each exercise is because today it is much more common that companies are using perpetual systems rather than periodic systems. And so our assumption generally will be, yes, they're using a perpetual system. But really it would be more appropriate if they stated that on the face of, in the text of the exercise. So we're selling it on account, so our accounts receivable is going to increase. So debiting accounts receivable. And we're going to record the revenue, the sales piece, but we're also going to record the sales tax payable. So the tax amount does not affect our revenues. Our revenues are going to be only the part that's ours, the part that we're charging our customers that we get to keep. By the way, some of you may be familiar with the concept of a value-added tax. We hear that tossed around once in a while, usually in campaign season. So a VAT, or value-added tax. If you've done any traveling in Europe, you're probably familiar with this concept of a value-added tax. A value-added tax, one thing that makes it different to the consumer is it's built into the cost of the product. So when people who live in the European Union come to the United States, probably the first time, they're surprised when they approach a checkout counter with an item that's labeled $10 and then they're told $10.80. But it says it's $10. So they're used to that $10 includes the tax, so it's kind of hidden. And if you are an American traveling in the European Union and you buy products that have that value-added tax, but you're taking them back home, you can actually get that tax refunded to you. Basically, when you get to the airport, you go to the tax booth and can get that refunded to you as long as you have the receipts that show that value-added tax. So, because we don't have to pay that. It's kind of cool. Let's go. I charged my calculator and I remembered to bring it with me today, so I'm back in business with my calculator. The revenue was $640,000, but that's subject to a 7% tax. 7% of $640,000 is $44,800. $44,800 worth of tax on top of the cost of the merchandise. And so we are going to bill our customers $684,800. I just added up the two credits to see how much we are going to bill them. $640,000 belongs to us, the seller. The $640,000 shows up on our income statement. The sales tax does not show up on our income statement at all. Remember, the accounts receivable and the sales tax payable are both balance sheet accounts. So from this entry, the part that shows up on our income statement is only the revenues. But our customers are going to pay us both our portion plus the tax portion, and then we will remit that tax portion to the taxing authority, state or federal or local government, when it's due. Because we use a perpetual inventory system, then we also need to report the cost of goods sold and the reduction in our inventory of $385,000. And that line, the cost of goods sold, of course, is also going to show up on our income statement. And so as we make these sales that include tax, we keep setting aside or earmarking that tax as being due. It's a liability. It's a payable to some other taxing authority. We are acting as the collecting agent or the pass-through. We bill our customers, we receive the cash, we pay it to the state, the generic state, the government. And then when we make that remission or the payment to the state, we're going to reduce our payable and make that payment, use cash to make that payment. So we'll see this concept again when we get to the current liabilities chapter, which is chapter 10. Because this is something that can easily cause trouble for a business when the business owner is not savvy about the accounting requirements. Because think about what's happening here. We sent out bills, just going to round off, we sent out bills for $685,000. And we'll assume that our customers paid us, and now we have $685,000. And maybe we don't have to make the sales tax deposit until the 15th of the month or whatever. But meanwhile, we've got that cash sitting in our bank account, and we have other bills that are due. We have to pay our employees. We have to pay our suppliers, so they'll keep selling us stuff. So even when we did the accounting correctly, we still have that cash, and it's an easy trap to fall into, to think, I need to use that money to pay this bill or to take care of this obligation, and then I'll just use the money that comes in next week to pay that tax deposit. It will come up again in chapter 10, because the taxes that are collected out of payroll actually amount to usually much more than the sales tax piece. So it's really simple to get caught up in that. And you do occasionally hear about companies getting in serious trouble, fines, getting shut down, potential for jail time, because you are not handling that payment correctly. Yes, we receive the cash. We collected it on behalf of the taxing authority, or we withheld it from our employees' paychecks, but it's not our money. Green check marks in there. So any questions about the handling of sales tax? Okay, it's a balance sheet transaction. We're collecting on behalf of someone else. It is not our money. Yes, it does go through our accounts, but it doesn't affect our income statement. Okay. Let's keep going then. So we talked last class about perpetual versus periodic inventory. We talked about this concept of inventory shrinkage, that we had inventory, we no longer have it, but we did not sell it. So how do we account for that? How do we even know about it? Well, if we use a perpetual inventory system, we know that we had it and we don't have it anymore, because we've been keeping track of that cost of goods sold. Every time, we just saw that in a couple of these exercises today. Every time we make an entry, every time we make a sale, when we use a perpetual inventory system, we are recording that cost of goods sold and removing it from our inventory account. Regardless of whether you use a perpetual system or a periodic system, when we get to the end of the accounting period, we're going to take a physical inventory. So how often we do that depends on the type of organization we are. The minimum requirement is that it's done once a year, usually corresponding with our auditor's visit. If we use a periodic system, we're going to need to do a physical inventory more frequently than that, because we have no way of knowing how much we have. We haven't been keeping track as we make each sale. And so we have no way of knowing how much we actually have until we physically count it and assign a value to it. Our next chapter is focused almost exclusively on that assigning a value to it. How do we know how much it's worth? And so we'll get to that in chapter 6. But for now, in this exercise, we are told we've been using a perpetual inventory system. So every time we make a sale, we've been not adjusting, but correcting, making an entry to record that reduction in our inventory and an increase in our cost of goods sold. And so when we get to the end of the period, our records show that we have $3,145,000 worth of inventory. But just to be sure, we take a physical inventory and we assign a value to it, and we determine that this $3,113,500 is how much we actually have on hand. The difference between those two numbers is what we refer to as inventory shrinkage. We had it, we no longer have it. We need to record that. So how do we record that? Well, let's figure out, let me just do the math quickly and figure out how much is missing. $3,145,000 minus 3,113,500 is 31,500. So we have to ask ourselves, is this a number that's big enough to matter? Is it a material number? So we hear that term a lot in accounting. Is it material? Is it big enough that it matters to us? And our general rule is going to be that something is material if it's more than 5% of the total. So 31,000 out of 3 million is about 1%. 31,500 sounds like a lot, but compared to 3 million is a pretty small number, about 1%. And so because it's less than 5% of the total, we're not going to be too terribly concerned about that unless we think it's the result of fraud. Any amount, no matter how small, is a concern for us if we think it's as a result of fraud, some attempt to defraud the organization or defraud the investor. We talked about last class what this inventory shrinkage might include. It could include items being stolen, being damaged, being, if it's a grocery store, it could be that things spoiled, got thrown away, were given away as samples. All sorts of things that could have happened to it. Most of those are just legitimate business purposes. Giving away samples is a very legitimate business purpose. Now, some organizations are stricter than others about keeping track of that. And that's fine. That companies that run on tighter margins, like a grocery store, like Walmart, needs to be maybe much more careful about that than a company that runs on 10 or 12% margins. So how do we account for this? Well, we have the inventory, we no longer have it. Even if it wasn't actually sold, we are going to treat it as part of cost of goods sold because it's part of the cost of just doing business. Even if it was given away as samples, it's just part of the cost of doing business. And so we're going to include it, add it to that 31,500 to the cost of goods sold. Because it's still in our inventory and we no longer have it, we need to remove it from our inventory account so that the inventory is correctly stated on the balance sheet. And so that is the entry to adjust or correct our inventory because it's not a material amount. Now, I'm not suggesting that we just take this in stride and say, oh, well, it's gone. If we think that we may be the target of someone who's stealing, we're going to want to set up some kind of a system to help prevent that. There are acceptable losses, and I would suggest this is less than 1% or about 1% of the inventory at the end of the year. We might just count that as an acceptable loss. What we would want to do for sure is compare, well, how much was it this year or this month compared to last year or last month? So we want to keep track of that. And if we see a spike in this inventory shrinkage, again, we're going to want to be more careful about that and take action, come up with plans. In chapter 7, when we talk about internal controls, this will, and you read about them, this will come up again. So how do we try to prevent that inventory shrinkage? But some amount of it is just simply going to be a part of the way we do our business. Get rid of that notation. Okay. Questions so far? Any questions? I should have said at the beginning of class, if we get to the end of the chapter and we still have time today, we are actually going to move ahead to chapter 6 today as well. We could use a little bit more time in chapter 6 to make sure we finish on time so that you're prepared for that exam. Because I'm feeling pretty good about where we are at this point. Exercise 8, adjusting entry for customer refunds, allowances, and returns. So we talked about returns and allowances last class. Again, we talked about the, an allowance being kind of a discount. Yeah, we know it's damaged. We don't really want it back. How about if we just, lop some off your bill and you just keep it? A return, we saw in that earlier exercise today, how we would account for those returns. We assume that the returns can be restored to inventory and be available to be resold to another customer in general. Sometimes that's not true. Sometimes a customer might return inventory to us that maybe we can fix or rework or sell at a lower price, discount them. Exercise 8 says Stats Company had sales of $1.8 million and related cost of goods sold of $1,150,000 for its first year of operations ending December 31st, 2021. Stats provides customers a refund for any returned or damaged merchandise. At the end of 2021, Stats Company estimates that customers will request refunds for 1.5% of sales and estimates that merchandise costing $16,000 will be returned. Assume that on February 3rd, 2022, so the next year, Buck Company returned merchandise with an invoice amount of $5,000 for a cash refund. The returned merchandise originally cost Stats Company $3,100. So I need to go back to something I was explaining earlier in class, that the matching principle requires we report revenues when we've earned them, and then we match against those revenues any expenses that help to generate those revenues. And sometimes those expenses are not yet known. Sometimes we have to estimate what those expenses will be. That's what they're explaining in this line right here. And I don't know why it won't let me highlight down to the next line. In 2021, Stats reported the revenues of 1.8 million, and they needed to match against those revenues any costs associated with that. Some of those costs are the cost of granting refunds to our customers. And so they had estimated 1.5% of sales. Whoops. Point. Sorry. Give me a second here. Point. So 1.5% of their sales, 1.5% times $1.8 million is $27,000. They estimated that they would have to refund $27,000. So the matching principle says, well, you need to get that $27,000 into the books in 2021 at the same time that you're recording those revenues. Those are expenses that go with these revenues. The cost of those refunds are expenses. We need to record that in 2021. We set up allowance accounts. Again, we'll talk more about this in chapter 8. We set up allowance accounts to kind of put aside that money on our balance sheet so that we record the expenses in the proper period. And then when our customers ask for those refunds, we aren't recording expenses next year when the sale, the revenue happened this year. Okay. Everyone, okay, let me just put that calculation on the screen in case. So $1.8 million was their sales, and they expect 1.5% of that to be returned That is $27,000. Okay. At the end of 2021, they need to set that value aside, and that's what we're going to be doing in our first entry here. Oops. I apologize. I didn't realize that was going to jump over quite that much. See if I can fix that so it's not covering it. So we estimated that $27,000 worth of our sales would be returned. And so we reduce our sales by that 27,000. And we set aside in this payable, the liability customer refunds, we set aside that 27,000. If we go back to, if I can find it here, where did we do that refund earlier? There it is. So if I go back to the very first exercise, and I kind of glossed over this because we hadn't talked about it yet. So I want to come back to this exercise. The first one where we issued the credit memo, and I said, we're reducing that liability. We are debiting the customer refunds payable. Now we can see where that came from. That customer refunds payable was set up, that liability was created because we anticipate that in the future, our customers are going to want to return some of that product. And so we set up that liability. We think we're going to have to pay them back, refund their money. And in exercise 4, that's what happened. We refunded their money, or issued the credit memo in that case, because they hadn't paid the bill yet. And we reduced the liability. Oh, now somebody has actually requested that refund, so now we don't have as much liability in the future. It is an estimate. We can see that here. We don't know exactly how much is going to be returned, but we estimate it, and we do the best we can with the information we have. So if you were questioning that back in exercise 4, nobody said anything, but if you were questioning that, I hope that makes more sense. Does anyone want to ask a question about it now? Is that, everybody's okay with that? It's an estimate. Here's how much we think we're going to pay back. Oh, in exercise 4, now we paid some of it back, so we owe a little bit less. The other piece of this, though, is that cost of goods sold. Okay, so the next line here says estimates that merchandise costing $16,000 will be returned. So we set this aside as well. This is an asset, estimated returns inventory. And we're going to reduce our cost of goods sold. So for the $27,000 worth of stuff that we think they're going to return, we estimate that would have a $16,000 cost to us. So at the same time, we're reducing the sales to reflect those future returns. We decrease the expense cost of goods sold. And again, if we go back to exercise 4, you'll see, there it is. The other side of that, when we accept the return, we reduce the liability and we also reduce the asset, estimated returns inventory. So now we can see where those numbers came from, how we set aside that value based on our estimates at the end of the period. And as I said, we'll talk about this more in chapter 8. But any questions so far? So at the end of the period, we set aside these values. And then in the next period, we actually, on February 3rd, we actually had a customer request a refund, return some merchandise. And so at the time, this is going to look very similar to what we did in exercise 4. At the time that we receive that request or receive the return of the inventory, we're going to issue them a refund. Okay, so let's give them some cash. We're going to issue them a cash refund of $5,000. That is right here, $5,000 for the cash refund. We're going to use cash to pay them their refund. Remember here at the end of the year, we set up this payable because we knew that some people, we didn't know who, we didn't know how much, but we estimated how much. And now that we're actually making a refund, we're going to reduce that liability. We think because we refunded this customer, Buck Company, we have less that we anticipate being refunded to other customers. We reduce our liability and we pay them back. And that merchandise had a value of $3,100 to us. So we're going to add that back to our inventory, assuming that the inventory is still saleable. If it is damaged, if it's destroyed for whatever reason, we're not going to add it to our inventory. We only want to put it in our inventory account if it is available for sale. And at the same time, we're going to move it out of our estimated returns inventory that we set up back at the end of December. It's no longer an estimate. Now we have an actual return of inventory. We're going to add that back to our inventory. Questions about how we handle these returns? And we had to estimate up front because the matching principle says, when you record those revenues, you need to make sure you get all the expenses that go with that. And part of that is we might have some returns that don't happen in that same fiscal period, that same accounting period. Everybody good? Let's keep going then. I think last week, actually I know last week I showed you in the PowerPoint an example of what a multi-step income statement looks like. So we've been doing income statements since chapter 1. We know the general format of an income statement is revenues minus expenses equals income or loss. What I showed you last class, and let me, if I scroll back, I can put that back up on the screen. Just don't know exactly what's. There it is. Okay. So I showed you this slide last week and we talked about a multi-step income statement or a classified income statement. Similar to what we did with the balance sheet in chapter 4, that we took the existing information, we didn't change the totals of the information, but we just broke it down a little bit, just like we did on the balance sheet when we put in current assets and property, plant, and equipment, and current liabilities and long-term or non-current liabilities. We're doing the same thing here. We're taking our expenses and we're dividing them into 2 categories. We can label these categories. Cost of goods sold is what is known as a product cost, and operating expenses are called a period cost. The product cost, cost of goods sold, is the cost of the inventory, the cost of buying, or if we're a manufacturing company, it would be the cost of making the product. We said that cost of goods sold includes what we paid our suppliers for the merchandise plus that freight in. We talked about that quite a bit last class. The operating expenses are period expenses. They hit the income statement in the period in which they're incurred. This includes selling, general, and administrative expenses. Cost of goods sold Another word for that, just put it up here, is inventoriable. These are inventoriable costs, meaning they go on the balance sheet as inventory until we sell them. So for our cost of goods sold, for our product costs, it doesn't matter when we bought them, it matters when we sold them. When we buy them, they go on the income statement, excuse me, when we buy them, they go on the balance sheet as inventory. And they stay there until we sell them. At that point, they become cost of goods sold on the income statement. And so in our next exercise, we're going to be looking at producing our own multi-step income statement. The first step is this gross profit or gross margin. We then have operating expenses. Sometimes we have another step, a separate step for the income tax expense. That's income tax paid by the business, by the organization whose income statement it is. Sometimes on a more complex, a corporate form of the income statement, we have other revenues and expenses that would appear at the bottom of that financial statement as well. So when you look at the company that you chose for your project, you are likely to see additional information toward the bottom of that that appears after the line that says operating income, just as a heads up. So here's our format. We can see, as always, our financial statement has a 3-line heading: name of the company, name of the financial statement, the date or range of dates that it covers. So everything but the balance sheet covers a range of dates. So that third line will need to say for the year, the quarter, the month, the day, the week, or whatever ended such and such a date. We start with our sales and subtract cost of goods sold to get our gross profit. That's the first step of the multi-step income statement. Then under expenses, we're going to have our selling and our general and administrative expenses. We're going to add those together. That's our second step. We subtract that to get our operating income or operating loss if our operating expenses are greater than our revenues. This is what I described, that you may see other, these are referred to as below the line or non-operating items. So I could put a line right through here. Anything below that line is referred to as non-operating. Non-operating items. And those are items that we don't want people to consider when they're using our financial statements to predict the future. So we spent a lot of time in chapter 1 talking about why we do accounting in the first place, who's using this stuff, and we know it's people who are trying to make decisions about our company. So anything that's below that line that I put there and labeled non-operating items are items that we don't think are representative of our company. They may not continue into the future. They're not related to the day-to-day running of our company. And so if people are using our income statement to make decisions about our company, we really want them to focus on this part, the part that is included down to operating income. That's the day-to-day running of our business. That's how we're doing. Now, I happen to have a printout of this exercise, so I'm not going to scroll up and down to get the information. I want to just leave it right here. But you may need to refer to the top of your page of your exercise to see this information. We're given a bunch of information, balances from accounts appearing in the ledger. They appear to be in alphabetical order. We know that in the ledger they would appear not in alphabetical order, but in that prescribed order, assets from most to least liquid. liabilities from current down to long-term, the permanent equity accounts, which right now include common stock, retained earnings, then the temporary accounts, dividends, revenues, and expenses. We know that in the ledger, they would appear in the same order they appear in the chart of accounts, and that's the order I just reviewed. These, though, are given in alphabetical order, which is not at all the way we would find them. But they've given us a number of accounts here that are not going to appear on our income statement. We look at those first accounts, accounts receivable, accumulated depreciation. Those are balance sheet accounts. So we're not going to be using everything that's given here. We're looking only at the income statement accounts. We start with our sales, $8,245,000. We subtract from that our cost of goods sold. That's an expense account. That is the cost of the inventory, the cost of what we bought from our suppliers and then sold, plus potentially any freight in. As I've said in earlier chapters, if it helps you to remember, you are welcome to put a minus sign in front of that if it helps you to remember to subtract. The software will accept the minus, but it will also accept it without the minus sign, as long as it doesn't say specifically to use negatives. It will accept it either way generally. So if it helps you to remember, go ahead and put in that minus sign. And then we subtract to get our gross profit or gross margin. We go on to those period expenses, the operating expenses, selling and administrative expenses. And we add those together to get our total operating expenses. And again, you can show it as a positive or a negative. If it helps you to remember to subtract, the software will be happy to let you put a negative in there. We're then going to subtract that number from the gross profit to get our operating income, or if the gross profit was less than the operating expenses, we would have an operating loss. Oops. Everybody good so far? Okay. So these other revenues and expenses, again, these are items that are not part of the normal running of our business. We can divide our business activities into three separate areas, three distinct types of activities within our business: operating, investing, and financing. Operating activities are the day-to-day running of our business. Hiring people, paying our employees, buying product or making product, selling product or services to our customers, billing our customers, collecting payment from our customers, the day-to-day operations of our business. This is what we are in business to do. Those are the types of activities that are showing up here in the main portion or the operating portion of the income statement. And as I've already said, that's the part that we want people to focus on. This is why we're in business. This is what we do. Sell product or service to our customers and all the things that support that. The other two types of activities, again, I can draw a line here. The other two types of activities both serve to support the operations of our company, but would not allow us to continue in business if we didn't have sound operations. So investing includes The buying and selling of plant assets. So we need a new piece of equipment, or we have an old piece of equipment that's worn down and needs to be replaced. We sell off the old one, we buy a new one. That's an investing activity. Investing could also include financial investing. So we have some excess cash. We don't need it right now. So we put it into stocks or bonds to maybe give us a little bit of return until we actually need that cash. So buying and selling of financial assets like stocks, bonds in government bonds, stocks or bonds in other companies, those are investing activities in addition to buying and selling of the physical assets, the equipment and buildings and so on. So clearly those are things we're not doing every day, right? If we're a grocery store, we're not every day buying new equipment or selling off used equipment. The financing piece is just as it sounds, just as you would expect. It's where do we get the cash, the money to do these other things? So financing includes borrowing money, paying it back. It also includes stock-related transactions for our own stock. So if we're selling shares of our own stock, if we're paying dividends to our stockholders, if we are buying back some of our own stock, we'll focus on those in chapter 12. The financing part we'll be looking at in chapter 11, which is the long-term liabilities chapter. What we are focused on right now, and it's the main body of our income statement here, is the operating section. And right where I've drawn the line here is also really where I've drawn the line here between these activities. So other revenue and expenses would include things that aren't in the normal running of our business. And as I look at that, at the list of items that are given there, oh, isn't that funny? It's cut. Oh, there it is. It's the one item that appears at the top of my printed page. It happens to be the last item. Point to it right here. Happens to be the last item right here, interest expense. So interest expense is related to paying back that money that we borrowed, and that's a financing activity. So interest expense is going to go down here in the non-operating items. It's related to a financing activity. It's not related to the day-to-day running of our business. I'm going to show this as a negative. Again, you don't have to show it as a negative, but if it helps you to remember to subtract, please do. Please do show it as a negative. We could also have interest income, by the way. We could have some investments that are paying interest or dividend income. Those also would be considered non-operating items. And then our bottom line then is net income. Net income, where operating income is the part that's above the line. It's related to those operations, and we exclude or force below the line those investing and financing related transactions. This setup, the three activity, dividing all of our activities into those three areas, is also going to be important for us when we get to chapter 13 on the cash flow statement. This is how the cash flow statement is organized. Operating, investing, and financing activities are all separated, into those three categories on the cash flow statement. Okay, before I remove the drawings and stuff from the screen, any questions? So the bottom line net income, oh, we have one more question here. What is a major advantage of the multi-step income statement over the single-step income statement? Clearly presents the value of total expenses. Well, our total expenses are on all the income statement. It doesn't matter how you organize it, the expenses are all going to show up on there. The bottom line net income is going to be the same whether you use this format, the more complicated corporate form, or a single step like we learned in chapter 1. So that's not an advantage. Clearly presents the total of the value of total revenues. No, revenues are also the same regardless of whether you use single step, multi-step, corporate form. Those are all on there. Multi-step is less complex. No, it's actually more complex. And so by process of elimination, I know it's going to be this one, but let's read that. The multi-step income statement shows the relationship of gross profit to sales. And that is definitely the answer. Gross profit or gross margin doesn't show up on the single step income statement. We can calculate it, right? If you are a decision maker looking at a simple income statement, a single step, where all the revenues are lumped together, all the expenses are lumped together, we can calculate gross profit or gross margin. But in the multi-step, you don't have to calculate it separately because we give it to you. The same exact concept that we talked about with the classified balance sheet. We aren't presenting any new assets, liabilities, and equity. We aren't presenting here any new revenues and expenses. It's just how we group them together to help decision makers better see the information that they might need to make decisions about our company. Everybody okay? Okay. Let's move on. Final exercise for this chapter. Closing entries. So we actually, this is not new in this chapter. We talked about closing entries in the last chapter. It was part of the appendix, one of the appendices in our chapter, in our previous chapter. And I told you you didn't have to read that appendix, but it is important that you recognize how closing entries are done. And so we're going to look at that one more time. The idea of closing entries is we need to zero out or close all of our temporary accounts. And I had explained to you in that class that some companies might choose to use a simplified process, as we are going to use here, a two-step process. Some companies may use a four-step process. So I've already explained that in an earlier class. I'm not going to go through that whole thing again. Certainly, if you have questions, you should ask. But for this class, we're going to be using the two-step process. The first step, you can see there are two entries here. The first step is to close the revenue and expense accounts and move the net income or the net loss to retained earnings. And the second step is to close the dividends and move those dividends to retained earnings. So as we look at all the information that's given here, we know that the only accounts that are going to be closed are the ones that are temporary accounts: dividends, revenues, and expenses. We know that we're going to assume, it doesn't tell us here whether they're debit or credit balances. We will assume that each one of these accounts has the normal balance for that account. So our revenue account right here, sales, doesn't tell us, but we're going to assume that has a credit balance. So to close sales with a credit balance, we need to debit sales for that same amount, right? Has a credit balance. To close it, we need to debit the exact amount that's in there. Now it will have a zero balance. We've closed it. If our company made money, we're going to increase retained earnings. That means we're going to be crediting retained earnings. If the company lost money, we would be debiting retained earnings. I don't know, looking at this, it doesn't tell us yet what the income is. I'm just going to assume for the moment that the company made money this period because that's the more likely scenario. If they lost money, we would need to be debiting retained earnings here. I'm going to assume for the time being that they made money. And so we're going to move right on to our expenses. So as I go down this list, accounts receivable, nope, that's an asset. Accumulated depreciation on the building, nope, that is a contra asset. Administrative expenses, yep, that's an expense. So somewhere in here, I'm gonna find, there we go, administrative expenses. Now I know I've said this before, but in case you're wondering, how do you know that that goes on the fourth line? Other than the fact that the debited accounts go first and the credited accounts go after the debits, there's no wrong order to put the credited accounts. The software guides us to where it wants it, because if we put it on the wrong line, it's going to put it on the line it doesn't expect. It's going to flag it as being wrong. So it guides us. But in a real world situation, instead of having a drop down that just shows 5 different accounts, that drop down would show every single account the company has in its chart of accounts. So there is no wrong order. There's just an order that's not what the software expects. Cost of goods sold is an expense account. It has a normal debit balance. So to close that account, we would need to credit for exactly the same amount that's in there. Selling expenses. Again, these appear to be in alphabetical order. Oops. What else do we have? Interest expense. So we've got all of the expenses that we put on that income statement in the previous exercise, plus the revenues. In the interest of saving time, I'm just going to look over here, because this is the same information from exercise 9. We had calculated on this income statement that the net income of the company was $1,720,000. So we want to add that $1,720,000 to retained earnings. Retained earnings is a permanent equity account. It has a normal credit balance. And so to increase that, we're going to credit retained earnings. If we had not just done exercise 9, how would I know how much to put here? If I hadn't just made the income statement for this company, how would I know what this dollar amount should be? Anybody?
Subtract the expenses from the sales.
Yep, exactly. So we would add up all of those expenses and subtract them from the sales. In other words, what's the dollar amount we need to make this balance so that the debits and credits are equal? That's the end, or the simplest answer is, this is a journal entry. It needs to have equal dollars debited and credited. So I just need to figure out how much do I need to add on the credit side so that the total credits equal the debit. That's really what we're doing. Okay, so that's step 1 of the 2-step closing process. In that one step, we closed the revenues, we closed the expenses, and we added the income to retained earnings. The second step is closing dividends. So why do we do dividends separately? Because dividends is not part of income, and we've talked about that a couple times already this semester. We don't call it dividends expense for a reason, because it doesn't help us make money. It doesn't help us generate revenues. We did not just put it on the income statement in exercise 9. Dividends is like an expense in that it reduces our retained earnings. And so to close dividends, which has a debit balance, we would need to credit the dividends account, and we debit retained earnings, which reduces our retained earnings. Remember, another way of thinking about dividends is earnings that we did not retain. We paid them out to our stockholders. So there's our two-step closing process. Any questions about this chapter? Just went through quite a bit today. We're not going to end class early. I am going to stop the video at this point and restart a new recording for chapter 6. And we'll do a brief intro to chapter 6. So I'm going to stop the recording.